No, not reversing entries. Yes, this is the last of 17 videos describing the basics of accounting. Let's finish off this discussion with the last topic, reversing entries.
The time to study reversing entries is about a month after you've done transactions analysis and learned aid and lure, debits on the left, credits on the right. Reversing entries really are reversed. So you get scrambled with everything else going on in these early chapters. I remember the first time I presented this a month into the course, and the whole class went, oh yeah, so what's the big deal? That's not what happened when I took this course. We had it in the first exam, and it scrambled my brain. My advice is, come back to this in a month, unless it's on your first exam. You'll discover here that reversing entries are just clever bookkeeping tricks. They achieve an elegant result at very low cost. We trick our silly little computer into doing what it always wants to do in normal situations and pops out a very complicated result. If we skip reversing entries, we'll have complicated journal entries for the rest of the year. Finally, reversing entries get their name because they reverse specific adjusting entries. Not all of them, just selected ones. Since we're talking about adjusting entries, let's go back to our 6-cell map for adjusting entries and see which ones do get reversed. The accruals on the left, they get reversed. And the deferrals on the right, they also get reversed. It turns out that the only ones that don't get reversed are in the middle column, the deferrals that have been recorded on the balance sheet. The unifying feature of these 4 cells is that whenever we hit this particular transaction, our computer wants to debit or credit an income statement account. So for example, every time we pay workers, we debit wage expense, credit cash. Every time we buy insurance on the deferral side, we credit cash, debit insurance expense. Looking at the lower row of the grid, every time we get cash deposited to our account for interest in our bank account, we debit cash, credit interest income. And every time a customer pays us, even for work in advance, we debit cash, credit revenue. These are the 4 scenarios that call for reversing entries. The easiest example is the one we already mentioned, how we pay workers every Friday. Our computer always debits wage expense, credits cash, $50 a day, 5 days a week. But as we mentioned in an earlier discussion, this year, fiscal year end falls midnight Wednesday night. So 2 days ago, we made this adjusting entry. Debit wage expense, that is year 1 wage expense. Credit wages payable. We owe our workers for 3 days of work. Now Friday, we have to unbundle the $250 into 2 pieces. We could do it in 2 steps. First, we could pay the liability. Then, we could record 2 days of wage expense for year 2. We could clean it up a little bit by making a compound entry, instead of making 1 entry for the payable and another for wage expense in year 2. But still, we have to remember that this Friday is not like every other Friday, where we just debit expense, credit cash. What we really would love to do is just do what we always do. Debit wage expense, credit cash. Now we've shown you how to do it the hard way, and we want to compare it to doing it the clever way. No matter what you do, you have to make the adjusting entry on Wednesday midnight. You owe $150 that has not been recorded on your accounts, and you've incurred expense of $150. In both cases, we close expense and reset the temporary account to show that we're about to begin year 2. But before we start year 2, we make reversing entries. If you look at the adjusting entry, we debited wage expense, credited wages payable. Now flip that entry. Debit wages payable, credit wage expense. That looks very strange. But the reversing entry name tells you that's what you're supposed to do. Take it on faith. Let's see what happens. What's really happened here is we've moved the liability of $150 to the T account called wage expense for year 2. After we make this reversing entry, wages payable has a 0 balance. If we do it the hard way, we're going to have to remember on Friday that that $250 payment needs to be split into 2 pieces. Debit wages payable $150, debit wage expense $100. But our computer just loves to debit wage expense, credit cash $250. Look at what happens when we do it using reversing entries. On Friday, the computer debits wage expense, credits cash like it does every Friday. All 3 accounts end of Friday show exactly the same balances. We have spent $250 in cash, we have paid off the payable, and we have $100 of year 2 wage expense. That is the upper left cell on our map of adjusting entries. Let's see what it would look like for an accrual where we're receiving the cash in the future. Let's do exactly the same entry from the point of view of the employee. The employee's also experiencing New Year's Eve on Wednesday midnight. So an adjusting entry would be made by the employee debiting wages receivable, crediting wages income. Remember, our expense is our employee's income. Our payable is our employee's receivable. At the end of the year, the employee would make a closing entry, closing wages income into income summary, and from income summary into capital. Here comes the reversing entry. Debit wages income, credit wages receivable. Very strange looking entry. On Friday, we do what we always do. Debit cash, credit wages income, $250. Almost as if by magic. We're left with the debit to cash of $250. The wages receivable has been wiped out, and we have wages income for year 2, $100. We get a correct measure of wage income for both years 1 and 2, and our computer got to do what it always wanted to do. Debit cash, credit income. Everything we've said about accruals also holds for deferrals. Take a sheet of paper and prove to yourself that reversing entries will simplify the long-term bookkeeping process for these kinds of events. The general rule is this: any adjusting entry that increases a balance sheet account ought to be reversed. The 4 that we're talking about for reversing, either credit liability or debit asset, those are the ones that ought to be reversed.
Well, that completes our discussion of reversing entries. It also completes our discussion of the essentials of record keeping. In less than 2.5 hours, we have presented a pretty complete explanation of the essential ideas that underlie record keeping. Please visit our website at enlightenup.net. There you'll find more materials to support your learning. The site offers a battery of questions that you might see on an exam. Each question is followed by a discussion of the question and an explanation of the solution. But best of all, visiting the site is free. I wish you the best of luck in your study of accounting.